Okay, well, a fundamental question in finance is what drives the stock market? Now, what you learn in most finance classes is that prices are the expected value of all future dividends, calculated in a rational and dispassionate manner. But the people who actually trade stocks are not computers. They're human beings, and even very powerful people are prone to mistakes and psychological biases. So, what I wanted to look at in my paper is what actually drives the stock market. Is it fundamentals or is it emotions? Now, in order to do so, you need a variable that affects investor mood but has no effect on a company's profits. Now, a previous paper looked at the effect of clock changes to and from daylight saving time. But a potential issue with this is that it's not clear that clock changes have a large enough effect on investor mood to feed through to stock prices. To be sure, when the clock changes, your sleep patterns are messed up, but Wall Street traders are very good at getting by on little sleep. Because of the clock changes, you just have another cup of coffee or snort another line of cocaine. So I needed a variable with a huge effect on people's emotions, and so that's why I decided to look at sports. So as you can see from this, these painful facial expressions, they certainly have a large effect on my emotions. But more generally, when England lost to Argentina in the 1998 World Cup, on penalties of course, heart attacks shot up over the next few days. And a bit closer to home, suicides go up in Canada when the Montreal Canadiens get eliminated from the Stanley Cup. And when the team is knocked out of the NFL playoffs, homicides go up in the local US city. Now, I couldn't look at a local competition such as the World Series because if the Phillies win and the Mets lose, for example, then some Americans are happy and some are unhappy, so it's hard to see what's going to happen to the overall stock market. So this is why I had to look at something international, such as the World Cup. Because if England loses, to Germany naturally, then the whole of England becomes depressed and the market may well go down. So my co-authors and I decided to look at 39 countries starting from 1973. We ploughed through 1,000 games. And the results were striking. We found that when a team gets knocked out of the World Cup, the market falls by 0.5% the next day, controlling for everything else that may drive stock returns. You might think 0.5%, is that a big deal? But applied to the UK stock market, that is $14 billion wiped off the market just because England sucks at taking penalty kicks. So we found the effect was stronger in the World Cup than in the European Championships and Copa America, which makes sense because the World Cup is the global stage. It's also stronger in the elimination stages, such as the quarterfinals, than in the group stages, because if you lose, you're instantly knocked out. And it's also stronger in the soccer-crazy countries, such as Italy, Argentina, and Brazil. When Team USA gets knocked out, the market goes up over the next day. So we found a similar loss effect in other international sports, such as cricket, which is compared to religion in India, rugby, which is compared to religion by the warthogs, and also basketball. But in none of the sports we studied is there ever a positive effect of a win. So sports can only ever lead to depressing outcomes, which may well be why the European economy has done so badly over the past couple of decades. So this is a paper that even the common man on the street can relate to, and it was used in the advert for the Nike advert for the 2010 World Cup, and also on ESPN, where two of these slides were taken from. And you might think, oh, it's cool and fun to write a paper about sports, but what I want to emphasize is this gets at a serious academic question. Is the market driven by fundamentals or by psychology? And this has important implications for you guys who pay our salaries and ultimately fund our research. Because if the market is driven by fundamentals, then prices are efficient and it's not possible to make money trading. So you shouldn't spend your time joining the Wharton Investment Management Club. But on the other hand, if the prices are driven by emotions, then the market is inefficient and you can form profitable trading strategies exploiting people's psychological biases. Because what the soccer paper shows is that the market overreacts to information. So a stock that has done really well recently is now too expensive, and a stock that has done badly recently might now be too cheap. And this forms the foundation for value investing strategies. So by educating MBA students on what drives the market, we hope that our research forms foundations for you to have successful careers in finance. Thank you very much.